Hello everyone, welcome. It's just Tuesday, 8th of March. Happy Women's Day, by the way, for if we have any women in our webinar today. So happy Women's Day to all of us. So today is pretty much a continuation of what we have seen the last 2 weeks. Remember that we have, like in the previous webinar, actually I had a two session webinar called Putting It All Together: Entry, Target, Stop Loss, Risk and Money Management. So today is the very last bit of that webinar called Putting It All Together, that we have seen everything from the very beginning. So today we're gonna emphasize on the money management. So pretty much the PDF the PDF version that I have, the PDF handout that I gave you, has the material that we have covered the last 2 weeks, plus what we will cover today. Okay, let's get back. Let me see. Let me know, as usual, whether you're facing any issue with our session, visual or audio one. I remind you that our email address is webinars@hotforex.com, so feel free to contact us anytime you want with any question that you might have. We will try to help. And let me just open the question box as well. Can't be downloaded. PDF can't be downloaded. Okay, why this is happening every single time? Okay, guys, is James the only one that's facing this problem, or if it's just James, I will send it to him via email as soon as possible. So if it's all of you, you have to let me know, so I will send a single email to all of you with the handout. Please let me know whether James is the only one facing this issue. Okay, with the PDF, I'm referring the PDF handout. Okay, until I have your feedback, I will move on to the admin. So the admin, to read out loud the admin, so we won't have it in our way. And we will start. It will be very fast, fast and a bit of a theoretical. Can't download it either. Oh, why is that? I don't understand. So you can see it, but you cannot download it, right? You can see that it's there, but you cannot download it. Yes, okay. Understand why it is happening. So let me remove it. I will try once again, and if still is the same issue, okay, come on, it's a bit slow. Okay, I have uploaded again, guys. Try again now. If not, then I will probably send it again to all of you. When I click on it, it opens up a web page with the error message. Oh God, why is that? This is what was the same issue as last time, and not really sure whether is the GTW, the webinar websites fault, or is it my end. Never mind, don't worry about it. Oops, sorry. Don't worry about it, guys. I will send it via email, so don't worry. Okay, just I have uploaded right now once again in a different way. Can you check now that it's working? If not, just ignore me. Same too, still nothing. Okay, don't worry, I will send it to you via email. Okay, so I see. Okay, yeah, don't worry, guys. I will send it at the end of the webinar. I will send over all of you the email, the email. So email PDF tool. Okay, thank you, guys. Okay, let's move on then with our webinar. Okay, close. Okay, so yeah, this material is provided as general marketing communication for the information purpose only and does not constitute independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for purpose of buying or selling of any financial instrument. Uh, all information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Really good, Shaik. Thank you very much for asking. Hope you're doing well as well. So, risk warning: trading leveraged products such as Forex and derivatives may not be suitable for investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved. Take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. Please read the full risk disclosure in our website. So it's all about risk and money management. So today we're gonna see. We will try to see what money and risk management are. Okay, because it's a vital and critical issue, critical topic of for traders, for the market industry in general, the forex industry in general, for investors and etc. Also gonna see the difference between success and failure. Risk and money management can be the difference between success and failure. So what will make you succeed is an appropriate risk and money management. Don't ignore that. Yes, Shaik, a lot of the majority of the team, the folks that are here attending, saying that we have an error in the handout. I am aware. I will send it via email, okay? Someone also asked me about the link of the previous webinar. So I'm gonna give you the link, the link for the playlist, for the webinars playlist. Over there, they are anyway, they are sorted by date, so you will be able to see um, all of our webinars in English, of course. Um, So give me a second. Webinars. Where's my webinars? Okay, here it is. Copy link. So this is the playlist to all, sent to all, for the experience for the webinars for experienced traders, and this is the playlist for the intermediate or beginners. So you can see over there all of our webinars. Okay, so let's move on. So what is, okay, I'm not typing over here, what is money management or risk management? I will say it verbally, but the reason why I put this table on is I stole it from Stuart, to be honest, because I found it brilliant. Why the risk and money management is important. They are crucial, they are critical, they are significantly important because is the reason why, how we could avoid losing, and why we lose, why we could lose our money, why we could lose a part of our money, why we could lose in a trade and etc. There are 4 basic reasons, okay? 4. The very first one is because we haven't figured out the correct numbers. We haven't figured out the appropriate amount that we should invest, okay? Uh, According, of course, to our goals, according to our expectations, and the position sizing that we have, that we wanted to take. So one reason is that we have put too little, but we were expected too much. The other one, another reason is that even if we had a decent amount of capital, a decent amount of money in our account, we have risked too much. So we have exposed a big portion or the full amount of our money. So that's the second reason, which is usually the case. So it's how much we risk. That's why we keep repeating and saying, guys, calculate, actually do some risk management before enter the market. Make sure that you have predetermined in advance how much of your money you want to risk in every single trade. Another reason, over trading. We are either getting greedy, either getting panic, and we open a lot of trades in a single day, in a single hour. We are overdoing it, and we lose the control. We don't know what's going on. With too many open, we haven't set targets. We haven't set stop losses. Markets moving fast, and we are losing the control. And last but not least, why we lose? Another reason is that we don't really know ourselves. We haven't really sit down and I find out what kind of trader we are. Are we a person that is really patient? Really patient. So he can handle fast trading environment like 5-minute chart? Are we, like I am, very anxious, very stressful person? So the 5-minute chart is not for me. I prefer to be a long-term one, either a medium-term one. So uh, day trader, either a weekly trader as well. So I prefer to be calm because I cannot really control my anxiety and I'm not so patient. So this may sound a bit odd, but it's the truth. That's why I always said, guys, check. So before you open a trade, don't just say, oh, okay, let me try Forex industry. Why not? Let me try trading. Let's open that. Oh, it's going up. Let's open without really do any homework, any preparation. Like every single, you should treat, as I keep saying, you should treat trading as your own business. What I mean by that, you should have, like, if you were about to open a shop or open a business or whatever, you're doing a business plan, right? So the same stands for trading because you're risking your money. So prepare, sit down, write down a plan, identify what kind of trading is for you, how much you want to invest, how much you want to gain, how much you are willing to risk, so to lose, because we cannot always be right? Sometimes the market is turning against us, especially if there is a lot of volatility right nowadays, that is all about the war, the inflationary pressures, etc. So this is a table that you should always have in your head, stick in your head, in order to avoid these kind of mistakes. These are the key reasons why the majority of the traders um, uh, they could lose. Okay, so before I move on to the more um, um, on how on actually let me okay before we move on to explaining these 4 points and how you can overcome these problems, just briefly, I would like to repeat. Have done it in the past. I would like to repeat, refresh your memories on what we mean money management and risk management. Okay, so it's quite simple. Money management is the process, okay, of investing, spending, okay, your capital. Um, actually, is the process of investing or otherwise overseeing the capital usage of an individual or a group. So, in the Forex industry on the market, what we mean by money management is when uh, um, sorry, is when we um, prepare um, uh, when we manage how we gonna spend, invest our capital in advance. So that implies all the stages. So how much we will spend, we will invest, how we will improve the ability to invest and save, how we can achieve our financial goals. So this is what is money management is the way we could manage our money, okay, and that includes everything. Where we're gonna invest them, how we're gonna what we want to achieve, how much we want to gain back. So it's all the steps, okay. um, so is is a set of self-imposed rules that we should have as traders and to follow them in order to manage our money effectively, to minimize the losses, to maximize the profits, to grow the size of our trading account. Okay? So that implies under the umbrella of money management, we also have the risk management, because a way to achieve an appropriate, a good, an accurate, advanced money management implies that we already have done risk management as well. Okay, because if you want to effectively manage your money, so that implies to try and minimize your losses, maximize your profits, to grow your trading account, etc. That implies that you have risk management. You have done your risk management. Okay. Um, so, um, we're gonna okay. Some people confusing money management with the risk management. Okay, because they are very similar, correlated concepts. But just to clarify, the risk management is under the umbrella of money management. So money management is in general how we can protect our money. The risk management now is something more specific, is more about identifying, analyzing, quantifying all the risks that are associated with our trading in order to manage them effectively. So in doing so, it's how we could protect ourselves from the downsides of trading. Okay? So far, so good. So an old, like, how we call it? An old, like, phrase says that cut your losses short and let your winners run. So that should be your one of the mottos that you should have. Cut your losses short and let your winners run. What it means: minimize loss, maximize gains, and hopefully by doing so, you could become a successful and profitable Forex trader. Okay, so how are we gonna do that? Let's find out first what we are doing wrong, because without being aware what we are doing wrong, what the problem is, we cannot really improve ourselves, right? Okay. So I remember that the very first reason that I imposed was the fact that um, uh, we might have too little or too much money in our account. So that could be an issue. Why is that? First of all, because of the psychological impact. Okay. Um, so, so small capitals, I will start with this one first. If you have invested just $10, okay, $10, $50, I can see that very often. If you invest that little, you need to have in mind that you shouldn't have high expectations, because by investing a small capital balance, it can result in trades being taken that are too much of your total balance. So what I mean by that, exactly because you have too little, as if I just take as example $10 or $50, that means that even if you open a small trade, a small size, position size, possibly you will risking you are nearly full of your deposit, so all $50, for example. So you have an excessive risk. So you can say, but Andrea, I'm afraid. I I'm afraid that's why I sorry, they're asking for questions. So you might say, but Andrea, I am afraid that's why I started with $10, or I started with $50 and etc. Okay, fair enough. I understand that. I understand. Uh, Sorry. So let me just give me a second. Sorry, guys, give me a second. Okay, so sorry for that. So what I was saying, yeah, one reason for the traders to lose is if they have invested a very small amount of money um, in their accounts. And I do understand that. Okay, I do understand that that's you're afraid to put more, and that's reasonable. But why you haven't tried first in a demo account? Because having a deposit of $50 will possibly not take you anywhere. You could gain as little as $1 to $3 if you're lucky. So you don't it won't be easy for you to gain um to gain as much as you wish. So if you're gonna start by having small capital balances, you shouldn't be you shouldn't first of all you shouldn't have high expectations, and second of all you should have in mind that you're risking all those $50. Okay, you have, because it's a really small low capital. So it doesn't give you the opportunity to um, um, uh, to um, set an appropriate risk and reward level ratio. From the other hand, thank God we have we have leverage in the forex industry, so that gives us the advantage, the opportunity to make potential large profit with a very small investment, because you know what leverage is. Leverage can just it does give us the potential of a growth, but leverage also can just give us easily amplify our losses. So it's not always good. So in order a trader to control, even though, okay, we can say, we'll put just $50 because there is leverage, so $50 in the market will be 10 times more. Okay, so I mean, it gives you, with the opportunity for with small investment, it gives you a higher exposure to the market, so it could give you large profit as well. But it's a double sword. Okay, a trader can control the amount of leverage used by position size on the account balance, right? So if, for example, you have invested 10,000 and the position is so for one standard lot, $100,000 position would utilize 1 to 10 leverage. So you could open a much larger position if you are maximizing your leverage. But it's a double sword, as I said. You need to have in mind that you could indeed you can open a position 10 times more, but if you lose, you will lose the full amount as well. So what I'm trying to say is just small capitals can result in trades being taken that are really, really high in risk. So exposing your full amount, your full balance. Also, what other things that could be a problem? As I said, psychological impact. Okay. Um, Sometimes without really thinking that maybe our strategy doesn't work, we're trying so hard to win, and we're really, really disappointed when we don't have, when we're not really making enough profit back. And because of that, we tend to overdoing it, to say, okay, I will open more and more and more and more and more and more and more trades in order to make enough money back, enough profit back. But that's not the correct psychology. If you really, really work hard, but it doesn't give you fruits, maybe you need to go a step backwards and reconsider your strategy, amend it, test it. Okay? And you have to be patient as well. Profit is a profit, either if it is $1, if it is $100. Profit is a profit, so you need to be patient. You cannot really win in a single month 10 times more of what you have invested. That needs a lot of time, a lot of effort. So slowly. Also, never risk funds that you cannot afford to lose. If you have a decent capital, don't exposure the full of it. Okay? Respect your capital. Take small trades, small disciplined trades. If you had a decent amount of capital, maybe you have someone borrow them to you, or you won them in the lottery and you decided to invest them in the forex industry in order to gain even more. Respect your capital and take and don't take undisciplined trades. Stay patient, follow a strategy, follow a plan. Don't risk all of your money in a single trade. So reasonable initial capital also highly depends on whether you are a retail or institutional trader. Also, always size your account relative to your total personal equity. So net asset value. Risk capital should in general not represent more than 20% of your net asset value. Okay? Okay. So uh, uh, so let's move on. Let's move on. Five things to take into account when determining risk levels. As you might already understood, is leverage. We need to always have in mind what's the leverage of the asset that we are trading. We should determine in advance, actually before you even start trading in your life, you should decide how much you want to gain and how much you are willing to risk. So what your preferable risk and reward ratio. Also, what's the maximum exposure percentage wise that you want? So, okay, we can have we can have a risk and reward level per trade, but how much you are willing to expose in a single day? I mean, the sum of your trades. Let's say you have 1,000 invested and you open 5 trades that day, 10 trades that day, doesn't matter how many trades. At the end of the day, or by summing up all those trades, you are exposing only the 20% of your capital, not all the $1,000, just the 200. You need to have a limit. Regardless of how many trades you will take, you need to identify a maximum level for the day or for the week or for the month. It's up to you. Also, correlation risk and event risk. And I will explain later on what I mean by that. Okay, I'm not sure, dear Shaik, whether I can advise uh, the amount of money that you need to invest. Okay, that's that's not really sure where I can say that, but um, this is mainly based on you. Okay, on you. Um, so it depends solely on you. Okay. Um, whatever you are confident with, okay, whatever you can afford, first of all, okay. Yeah, this is the very first thing that you need to consider, how much you can afford, okay. Also, okay, let's move on and see in detail all these 5 things that you need to take into account for determining risk and money management. So we are getting a step backwards and getting back to the initial sorry, not the initial, let's move on. Here we are. So as I mentioned before, actually just let's take it step backwards. So the very first thing that you need to consider, okay, is risk and reward ratio and leverage. So let's move on. So one of the very first steps is to decide, based on your personality, what is the minimum risk reward that your personality will accept. This is the very first question that you need to ask yourself. Okay, before, even before even before depositing. So remember, if for those that they have saw our past webinars that they were like we were presenting trading plan, how you can create your own trading plan, how you can create your own trading journal, etc. The very first step after identify what kind of trader you are. So one of the very first steps is what is the minimum risk and reward ratio that your personality will accept, because all of us want to profit and we want to profit lots, right? So deciding the reward ratio is quite easy, but it's not easy to decide the risk ratio. So how much we could uh, we are okay losing. So um, so you should before deciding to enter a market, deciding to enter a trade, you need to set a realistic risk and reward ratio and targets, of course. Okay, so of course the minimum risk and reward ratio that it could be is equal to 1. So this is more or less the minimum risk and reward ratio that it could be set. Um, but a quite reasonable, we could say, risk and reward ratio would be 1 to 2 or even 1 to 3. So gaining double or triple, that's up to you, of what you're risking. Okay, so you need to set this kind of you need to take this kind of decisions in advance, because this will help you set your targets, your stop loss, and set some targets not only in a daily basis but in a weekly and in monthly. So it's not solely by setting your risk and reward ratio, but also setting some goals for the rest of the month, for the rest of the year. So it's good to have a plan. You need, because if you have a plan, it's like you're putting some restrictions to yourself, and that's good, because by sticking on those restrictions, by following the plan that you have determined in advance, you have you are limited the risk for you. And why you are limiting the risk, how this is possible, is because you will manage to control your emotions if you set these rules in advance. Okay. um uh, what else I wanted to say? So yeah, so you need to have set some goals and stick to it. If you decide that you want to win double or triple of what you are using that for every single trade that you're gonna take, you need to stick to that ratio. Okay. And here I give you just a tiny example. I said that, okay, I want always to win double of what I'm risking. So based on that parameter that I have restrict myself into, I follow this, and once I enter a trade, I am putting my target twice the distance than stop loss. So for example, if you're gonna trade oil and you have entered at $48, so, and you have identified that a nice uh, a nice target level will be at the 49 barrier, so 100 pips more, 100 pips higher than the entry point. So that implies that you should put your stop loss halfway, so 50 pips below. With this way, you are risking double. You are risking half of what you could win. Also, this is how the steps that you need to follow in order to appropriate apply a risk and money management. Also, how can I calculate this? How you can calculate the Arugo, what how much money you have to invest, how I don't get it, what you want to calculate. These are parameters that you need to set on your in advance, but we have some calculators, so don't worry, stay with me and I will give I will show you. So also it's a bit theoretical now, but I have some calculators afterwards. Okay, how to calculate the risk and reward ratio? First of all, you need to decide in advance. You want to gain 3 times more, twice more, how much money you want to gain? And be wise, okay? Don't tell me 100 times more of what I'm risking. That's impossible. Or it's no, it is possible, but it's too risky. So it's too risky because it might not never go into your favor. I'm gonna show you how there, but please decide first what you want to do. You want to win 3 times, 4 times, 5 times. How much you are okay. I mean, you feel confident of winning and losing. So, and I will show you how afterwards. Just the very few slides, we have calculators that they will help you with it. Also, before buying or selling a currency or an asset in general, we said that you have to set in advance your risk and reward ratio per trade. So this means divide your potential gain in pips after your take profit level is potentially triggered by your potential loss in pips. Okay, so general aim for a risk and reward ratio 1 to 2. This is a very decent risk and reward ratio. So if your potential gain is in pips is 20, then your stop loss should be 10. So if you don't really know in advance the Arugo, how much you want to risk, how much your risk and reward reward ratio you want to be, then you can identify it per trade. So for example, if you have this oil over here, okay, and the breakout of these highs over here got into your attention and you decided to enter at 48, and you saw that the next key resistance level is up here when we have this double top, or at the 49, which is slightly above this top and it's a round number as well. So if we decide that, okay, that looks to be like a nice target area, then you will measure the entry from the target. You find how many pips it is, and you will set the stop loss accordingly. So since we have seen that our entry is 100 pips away from our target, okay, then, okay, by measuring it, oops, sorry, come on, get back. By measuring it, you need to obviously set your stop loss tighter, right? If you put your stop loss another 100 pips lower, then it's a 1-to-1 situation, win-win situation. So okay, you might lose 100 pips if it goes out against you, but you might lose you win 100 pips if it's going on your favor. But 100 losing 100 pips is not a small amount, is a big amount. So it's better to detect, to put a tighter stop loss. So then a good idea to be is to set a stop loss halfway of your potential gain, or 1/3 of your potential gain. Smaller than that might be too tight, so you might kick you out of the market before it is going on, it goes on your favor. So a risk and reward should not be less than 1. Okay, although depending on if you are a short-term scalper or a duration trader, your risk reward levels will naturally varying depending on your appetite for volatility. Okay, so also that depends on what kind of trader you are. When your positions on duration trades are in profit to a desired level, you may wish to consider moving your stop loss. So, okay, let's assume that we have put the 1 to 2. Okay, the 1 to 2. So having our targets 20 pips higher, having our stop loss 10 pips lower. Okay, and it's moving in our favor. It already covered 10 pips higher. So we have another 10 pips until we hit the target. You can use trailing stops. You can, since it's moving on your favor, you can shift your stop loss higher or use trailing stop. That could manage your risk and you cut lock profits. Okay, so let's move on. Okay, it is important to set your trade amounts so that so you can ensure that your capital is protected and that no trade is more than a certain percentage of your total capital. So what we mean by that, let's assume that, okay, you have decided your risk and reward ratio, you had identified a potential entry level and etc. But guys, you might have in your balance 10,000. You don't want to risk all your 10,000 just in a single oil trade, right? So you need to determine in advance how much money from your capital will be invested in oil. So you can say, okay, I want to risk I want to from my capital, I want to trade only the $100 from my capital for this oil trade. So you need to determine in advance how much of your capital you want to invest in oil, let's say. Okay. So how you will do that? Okay, I have a formula on, but there is a different way of doing it. And this different way of doing it is by visiting our calculator. Okay, let me bring our website in. Tools, trading calculators. Okay, you will put on the asset that you want to trade. You can put on the entry point, which direction you want, where you have set your stop loss, what your whole amount is, but how much you want to risk from that amount. So if you have 10,000, but you want to invest in euro dollar only $100 of those 10,000, so $100 out of 10,000 is 1%. So I want to risk in this trade only 1% of my capital. So by click calculate it will give you how much your position, how big your position should be, the size of your position, and also how much you will give you the stop loss in pips. But anyway, you have identified the stop loss, so that doesn't really matter. What matters is that they will give you the position size that you should add in order to make sure that you're risking only $100 out of the 10,000 that you have in your amount. This is the way to calculate the Aruco. There are other ways as well. Another way is doing manually yourself. Okay, so this is for a more experienced traders though, but feel free to try it as well. So it's called Kelly Risk Management Criterion, and what it does is that it helps you by using the historical success rate profit factor per trade to determine a percentage level. So you need to um, subtract. Okay, it's a bit tricky, but um, So it's a bit tricky. So I recommend it only for advanced traders. Okay. So it's what this mathematical formula is. W, first of all, is the winning probability factor. So the probability of a trade will have a positive return. Okay, the R equals to the total positive trade amounts divided by the total negative trading amounts. So this formula actually is used to determine the optimal size of the trade when the expected returns are known. So if you are aware of the returns that you wish to gain, you can complete this formula and identify the size. But okay, I put it there because some of you might want to try it. Some of you might be experienced trader. You might count a lot of years in the trading. You might want to identify, to learn about this Kelly criterion. But as I mentioned earlier, I show you already the risk and reward calculator. So there are calculators that they do this calculator for you anyway. Okay, so this is just for your own just a general information. Okay, because a lot of institutional players are using this Kelly risk management criteria. So they are trying to identify based on the historical rate profit of that particular asset, what's the percentage risk. Okay, I'm not sure whether we can find this like available online per asset. Let me search a bit. I think there are certainly some uh, expert advisors that they include Kelly criterion, but to be honest, I haven't never used it myself. My own trading, I use these easy, straightforward calculators that I can find online. So I don't really need anything else. So that's okay for me. But if you want to try it, just search for it. I don't have I cannot really help you on that. I have never tried it myself, but I had to put it on to be aware what this Kelly criterion is. It's a Warren Buffett theory, by the way. I think he is the creator of Kelly criterion. So it's in general it's a method of analyzing your odds and assigning a number to those odds. So so it is used widely by big institutional players like Warren Buffett and Bill Gross in general. So yeah, that's why you can see it in a long term, you can see it being used by long-term traders as well. uh, so um, just once again, K Kelly percentage is the percentage of investors capital to make on each investment or bet. W is the historical win percentage of the investment strategy, and R is the investor's historical win or loss ratio percentage. So this has to do on your historical win and lose percentage. So you need to go back, check what you have done so far, identify how many times you have win, how many times you have lose, in order to identify your win or lose percentage. And with this way you will identify your very own Kelly percentage. So you are a very own um, uh, um, um, percentage of winning, let's say. Okay, so I know that it's get a bit complicated, so ignore it for now. Okay. So let's move on. Don't worry about the website. I have it in the very last slides as well, so we're gonna see them extensively. So what else? Let's move on. Okay, I mentioned before that another thing that you should have in mind, other than the risk and reward and the exposure, and of course the personality and etc., is the correlation and event risk. So guys, you are aware, especially now with the war, that there is a lot of volatility in the market. Also, there are events, some data releases, some political events that they tend to add a lot of volatility in the markets. Or there are also assets that they tend to be, by history, I mean, historically, traditionally, they tend to be um, high risk assets or assets with very, very high volatility levels. So these are things that you have to consider as well. Entering multiple currency pairs, okay, in a single day poses correlation risk. And what do I mean by that? If you, for example, if you have opened dollar Swiss and euro dollar, first of all, you have a correlation over here because both of them have dollar in. They are dollar pairs. So if you're taking a long on dollar Swiss, short on euro dollar, that means that you are taking a long dollar position, because trading long in dollar Swiss, it means that you are expecting the dollar to get stronger against Swiss, and you are taking a position short on euro dollar. Again, you are expecting dollar to strengthen against euro as well. So you have a correlation risk, as the two assets are inversely correlated, but you are in both, you are aiming for a strong dollar. Also, this is not wrong. This is not wrong, but I'm just highlighting it because it's bizarre if you take a long dollar Swiss and a long euro dollar, because that implies that what you are expecting dollar to get stronger and against Swiss, but you don't expect dollar to get stronger against euro. So that would be it's like you're taking two contractory positions. But yes, this is it poses correlation risk. So it is recommended, especially for intraday traders or scalpers, that um, it's okay if you want to take these inversely correlated assets, or if you have you have taken this kind of position, but you need to be aware of that, of the correlation risk. Okay, um, it's okay, you can do it, but it's preferably, and it will limit your um, losses if you consider trading uncorrelated assets. Okay, I'm not saying that is wrong. You can still do it. However, you need to set appropriate stop loss, target areas, and etc. Okay, but if you want to minimize even more your risk, it's better if you trade uncorrelated assets. Okay. Um, Actually, if you take short-term and scalping trades on the majors in an uncorrelated manner. What I mean by that, trading uh, so it's okay having multiple currency pairs, but make sure that you uh, either um, do that in a short-term view, so intraday, okay, intraday, or make sure that you uh, make sure that your overall direction points to the same thing, like in the example above. Okay, long dollar. This is what these two trades are. And also it's also good if you are considering not trading majors but trading emerging markets or exotic. Have in mind that this kind of trades, they have low liquidity. Okay, so for example, dollar ruble, now ruble is at record lows. uh, Polish zloty also at record lows. Turkish lira also at record lows. So these are called emerging markets trades. They are very, very volatile, but they are also have low liquidity. So that could impact your um, uh, your uh, um, oh, I'm lost, I lost my words. Uh, so that could impact your return of investment. So because they have low liquidity, okay? So have that in mind if you are thinking of trading emerging markets or exotics that they tend to have low liquidity. That could impact your return on investment. So the performance measure that you're using to evaluate how successful you have been on your trading. So for this is okay. So again, I'm saying that this is fine for short-term traders. For short-term trader, is fine. You can trade majors, you can trade correlation, you can trade inversely correlated assets if you want. You can trade, I don't know, assets that they have low liquidity, etc. But you need to consider that for the traders that they are long-term traders or medium-term traders, in general duration traders, these low liquidity assets are less of an issue in comparison with intraday traders or scalpers. Okay, so for duration trades, this is less of an issue, as I said, but correlation should be avoided in order to limit a bit the risk. So a good we have seen in the past the correlation map. If you download the premium tools, you can also see the correlation map. But there is online if you want to. So it's a good place to see which pairs have the highest levels of positive and negative correlation. So this could be a very, very useful widget or a tool, which we have in the MT4, or you can find it online. This will help you identify which pairs are correlated. Okay, so why I'm saying that, because if you know the which pairs are correlated and how much they are correlated, I mean 90%, 80%, if it's a 90%, that's a very, very strong correlation, then you can decide to take an entry on both on the same direction because they are correlated, so they are moving along with each other. Or you might consider um, scalping them. Okay, so where can you find the correlation metrics? Online, but also we offer it in our premium traders tool. Okay, so tools, premium trader tools, get down to the correlation metrics and download it, and you can see that in your MT4. I think I have it as well, so let me just, so here is my MT4. I have downloaded my premium traders tools, and this is the correlator metrics. Yes. Okay. So you see, anything more than 70 implies to a strong correlation. So we have a strong correlation for the 1 hour chart between Euro Yen and Aussie dollar. So negative correlation, sorry, positive correlation between euro pound and euro yen. So that implies that they move on the same direction for the intraday basis, etc. So this can help you. It can help you guys deciding uh, deciding whether you gonna take entries based on the correlation um, manner. Okay, so as for the event risk, it's I think that's really obvious, especially with nowadays with the geopolitic headlines and the war. So make sure before you enter a trade that you are aware of on any economic release that is about to be done within the day, any major event that could trigger your stop prematurely. You need to be aware of the economic calendar of the day, okay? Because a high event, a high impact event tends to add a lot of volatility during the release, so it might kick you out of the market prematurely. So the correlation, I have just shown where this uh, I just show you how you can download the correlation metrics. It's over here in our premium tool. So visit our website, go into our tools tab, go down to the trading to the premium trader tools. Okay, and you can download these. These are all the I think uh, 12 premium tools that we offer. So you can download them and apply them on your, you see, download now, and you can download them. Okay, I need to log in, but you can download them. And once you download it, it will appear on your MT4. Okay. How to use the tool having downloaded. It will appear on the left hand side of your MT4. Okay, you need to close your MT4 and open it again in order to appear over here. They will appear on the over here in the navigator under the expert advisor. So here it is, correlation metric. You just drag and drop it and you amend it based on your on the time frame that you are trading. So this will appear. Okay, if you are interested in medium-term correlations, then you need to put the daily time frame over here, decide how many bars you want these correlation metrics to include, and it will give you the correlations for. So you need to is a correlation exists only if there is more than 70% correlation. So you need to check only the red ones, because if it's less than 70, that implies that the correlation is not that strong. Okay, so if you are, however, a 1 hour trader, for say an intraday trader or a scalper, etc., you need to detect your time frame accordingly. Okay. So for in a 1 hour time frame, there is an inverse correlation for euro yen and Aussie dollar and euro yen and euro pound. Also a really, really strong correlation between euro yen and euro dollar, euro yen and cable. So you see, pound Swiss and cable, and so on and so forth. So let's move on. Okay, a very crucial part of risk management and money management is, other than setting your setting some rules, so setting your risk and reward ratios, setting how much you want to risk per trade, and etc. You need to identify, you need to set in advance your entry rules. So this is part of your strategy. If you have a strategy, obviously you have identified already and you have set your own entry rules. Okay, so that's a bit of a repetition of how you can create your own strategy. So some entry rules might be like a breakout of immediate support and resistance levels, or break or cross of our moving average, or a breakout of a candlestick formation, or I don't know, a breakout of 50 period moving average and um, and uh, and them and the RSI to clearly comply with that breakout. So that's solely up to you. That's solely based upon your strategy, your plan, or maybe based on the tools, the momentum indicators or oscillators that you use on your trading. So these are just some examples. Okay, so set entry rules, set certain conditions that needs to be achieved in order to take an entry. Not too many, keep it simple, keep it only what makes sense to you. If you like using moving average and you understand moving average and etc., you might consider using the crossing of a moving average or the breakout of moving average as your entry point. Or I don't know, if you have identified a breakout of a candlestick formation such as head and shoulders or I don't know, tweezers or etc., that might also be an entry point. Or if you are only entering if you are only open position only in the morning on the European Open, then that could be also an entry rule, because is a time of the day that you are free. It's before you go to work, so the only trades that you are taking is between 8 to 10. So set your own entry rules based on your personality, on the time that you have to spend on the market, and also um, um, on the technical analysis that makes sense to you and the setup that you are using. Okay, don't chase an entry if you miss it. Just wait for the next one. Also, um, so just very, very briefly, a method of setting an entry level is by considering the buying stop. If you have identified um, a candle high like this one, okay, or also, or you can use your, or you might have identified a buying signal, okay, that appears once we have a fractal low. So this is another signal, a potential actually buying signal. So it's good in general, guys, to write down, okay, any uh, to write down anything that triggers your attention. Write down any like, okay, I cannot say the word. Okay, anything that trigger your attention, and you might have seen a potential sell signal or a potential buying signal. So write down, keep a record of it in order to check it the next day to see whether it triggered indeed and break out any support and resistance level, and whether it's time to enter as well and to trade it. Okay, so write down anything that triggers your attention, or anything that it might gives you an early sign or a sell or buying signal, in order to check it on the very next day or the very next session, depends on what kind of time or what kind of trader you are, to check whether it triggered that uh, that trigger, whether it triggered any support and resistance level, and that might give you the chance to enter the market. So okay, that's so we are nearly done with our webinar. We have already covered all this in the very, very beginning. These are just some of the benefits of having done your own risk and money management. So mainly it gives you, it reduces, as we said, the stress. It keeps your head clean to make better decisions, and this could result in a reduction of risk and higher profit growth in your account. If you um, if you value your money, you need to trade professionally and manage your position professionally. And how you can do that? By risk and money management techniques and following the steps that we have already covered. With this way, you will feel more confident, okay? And you won't be driven by your emotions. So you need to make this as your daily routine, okay? And eventually it will feed back more confident and self appreciation, okay? So, okay. So pretty much that is just a bit of a summary of what we have seen today and what we have seen the last 2 weeks actually. Okay, I'm not going through the pending orders because we have covered it in the last two webinars anyway. It's another way of um it's another way of sorry. Ah, come on. The reason why I have put, let me just again the diagram of pending orders over here is just to remind you, okay, that if something triggers your attention, you have like in a particular trade, you have uh, continuous sell signals or buying signals, something that triggers your attention in general, you can set your own pending order, do your own money management, risk management, identify potential stop loss if this order is being triggered, set your targets as well, and leave it as it is, and will open the empty forward will open the position for you automatically, since you have already predetermined in advance your position size, your stop loss, your target levels, and your potential entry signal. Okay, so either to the downside or to the upside. This is just to save time and to limitate your risk. But let me get back and summarize a bit what we have seen so far. We have seen what is risk management, what is money management, and how you can achieve to overcome um, the key problems of that drives the majority of the traders to lose in a daily basis in the forex industry. So um, these 5 things that we have covered today are key for succeeding in the forex industry. So you need to, as we said, you need to identify yourself. You need to make sure that you need to make sure that you understand the forex industry. You need to predetermine in advance um, your risk management, and by saying that I'm referring to decide per trade how much you want to risk and how much you want to gain back, what exposure of your capital you wish to take per trade and per day, week, month, okay, in order to keep constant that percent. You need to remain constant. If you said that in advance you want to risk only 20% every month of your capital, then you need to stick to it. You need to open trades according to that rule that you have determined in advance. Also, you need to make sure that you are aware of any correlation or event risk, okay? What else? And set realistic risk and reward ratios, and stick to your plan. Still to whatever make sense to you. Yes, ask anything you want to, Ugo. So I promise that we're gonna see the calculators at the very last before at the end of our webinar actually. Hugo, you can ask anything you want. Go for it. I'm here and wait. So calculators that could help you with risk and money management are actually a lot. We have a lot in on the website. The very first that you need to consider is the position size calculator, which is this one. As we mentioned before, with the position size calculator, okay, you can actually calculate what should be the size of the position, okay, that you can't that you want to trade, okay, that you want to take. um, uh, so this tool will give you the suite will help you identify the volume. Okay, so by setting what kind of asset you were about to trade, was the account leverage, was the account currency, and etc., it will give you back um, uh, the um, the size of the positions in units. Okay, also another important calculator and very useful. I think this is significantly useful, especially for new traders. So risk percentage calculator, we said that you should determine in advance the risk and reward ratio and what's the percentage risk that you are willing to take per trade. So by inputting in this calculator which asset you are about to trade, what's your entry level, what the direction of the trade, whether it will be a long or a short position, where the stop loss will be, the balance of your account, but significantly how much you are willing to risk of that capital. So you cannot risk all of your money in a single trade, obviously. Okay, so you need to put a wise percentage, risk percentage. So that means like you want to risk only 1% of your balance for euro dollar, for trading, let's say short euro dollar. So put these parameters in and it will give you back how much the lot size should be, okay, in order to make sure that you are risking only 1% of your balance. Okay, so this is a really straightforward way to identify, to find out what's the suitable lot size that you should take per trade. Yes, you're right. So, okay, let's get back. Okay, you're right. The risk and percentage calculators has only Forex, but there are other indicators as well. There are other indicators doing something similar as well. For example, we have the risk and reward ratio over here. Okay, you can use that as well. So that doesn't have limitation. You cannot. You can actually, you see, there are a lot of calculators that they could help you. We have, if you are aware, identify already your targets, and you have more than one target. So this risk and reward calculator will help you to calculate the position, targets, and their risk and reward ratio. So by giving potential targets, it will give you back how much is the risk and reward ratio that you are imposing, so you can amend accordingly based on the results. Or is the okay, come on. In the position size, you don't have only Forex, you have also DMAs, energies, indices. So this is another tool that it could help you identify. So let's put oil, for example, energies. I want US oil and I want to enter actually, oops, enter the volume size. So if let's, for example, so if I put one full lot, then I'm risking 240 from my margin. If I put 200 only, that means that I should we should put as a volume only 0.4, not 0.4. So what I'm trying to say over here is that there are a lot of calculators. You don't necessarily need to use the risk and reward ratio only. Okay. Also, let's not forget which one could help you as well. We have seen position. We have seen risk and reward percentage. Have we seen that? The position size, have we? Yes, we have. What else? What else? What else? We don't want swap. I think you can have also, oh, not here, sorry. There is something also in the, okay, I cannot find it right now. Where was it? Okay, by downloading, okay, very last thing that I will say, dear Michael, by downloading, guys, the premium traders tools, there is one of the premium traders tools that is very, very useful, okay, very, very useful, is the trade terminal and the also the where is it? Where is it? The trade terminal and the sentiment trader. Okay, so these are very useful tools because they show you. So, for example, the sentiment trader is very, very useful because it show you live where the majority of the traders are. So live sentiment data. So if the majority of the traders are long on cable, it will show you what's the percentage of the traders that are long. So it will give you real-time market sentiment. So this is another instrument, another tool that is useful for taking your own risk management, money management, trading decision. Okay, so I would really like you to have a look on the Premium Traders Tools webinar, because there are a lot of risk management tools that you can use by just downloading our Premium Traders tool. Okay, because there are also the correlation metrics over there. There is the sentiment trader as well, presenting the real open position sentiment. Also, with the trade terminal, you can have automatically calculated the exposure of your balance, of your money. So there are a lot of tools within this premium tool that can help you, with your risk management. Okay, so I will end the session. I think we reached to the end. I think I covered everything. Feel free to ask me anything you want before we close the session. How to use the tool? We have replied to that. When identify the correlated pairs, how can one know the direction to take either long or either short? You need to check your chart, my dear Ugo. The correlation metrics present only the correlation, whether between two assets you have positive or negative correlation, and whether this is a strong or a weak correlation. It doesn't give you the direction. You will identify the direction by checking your chart, by checking whether it's moving up or whether it's moving down, whether it's moving in a downtrend, in an uptrend, whether the momentum is positive to the upside, whether the momentum is increasing to the downside. So you need to check your actual price action to identify the direction. The correlation metrics only presents whether two assets are correlated and whether this correlation is strong or weak or positive or negative. By saying negative correlation implies that they move on the opposite direction, okay? Or whether there is no correlation, because it doesn't necessarily mean that you will always have a correlation. Some assets are not correlated between them, so there is no correlation. So you cannot really trade based on that correlation. So there are webinars exclusively for correlation, so feel free to have a look. I'm gonna send to everyone the PDF in the email, okay? So okay, guys, I'm gonna call it a day because we are already an hour and a half live. So don't worry, I'm gonna send the PDF now, and the team will send the recording later on, as usual, okay? So thank you very much as well. Hope you're having a great day ahead. Take care. And we'll see you again tomorrow. Tomorrow we have, let me just check quickly the calendar. Tomorrow for sure, Stuart has the swing trading strategy part 2. And also on Thursday has the Vigor Index. And we have already the agenda for the whole month. The webinar agenda for the whole month is already on the website. So feel free to register on the webinars that you would like to attend. Okay, thank you very much. Have a great day ahead. See you again tomorrow. Bye bye.